All right, for more on the markets, let's bring in Verdence CIO Megan Horneman. She joins us here. Megan, great to have you with us. I'm going to pose the same. Let's start off the conversation with the question I posed to the desk, and that is markets at record highs here or a 4% CD for the next 6 months?
4% CD all the way.
Wow.
I wouldn't be. Absolutely. You know, I've listened to the other guests. We've talked about capitulation into year end. We've talked about momentum. I think we need to talk about complacency, and that's what we're seeing across a lot of different technical factors. You know, if there is chasing this market as quickly as the momentum can drive these markets up, as soon as that momentum loses steam, you're going to see those big names, the ones that there are actually profits on, they're the ones that are going to take a hit. And you're looking at, you know, Infotech in the S&P 500, these tech names, they're trading at a 90% premium, their multiples versus the historical average. This just simply isn't sustainable.
Let's say that one does believe that valuations are high and that it's not sustainable, but at the same time, you believe that rates are coming down. I mean, is that sort of the one thing that will kill this rally if the Fed doesn't deliver what the markets are expecting? Because it does seem that if you think that inflation is sticky and the Fed is sort of pinned, they might not, in fact, deliver as many rate cuts as the market wants.
Absolutely. And that's what keeps me up at night, is that this market is fully pricing in the fact that the Fed will just gradually cut rates at every meeting from here on out, that they'll save the labor market, that inflation we're completely behind us, that the Fed's going to just be satisfied with a 3%, you know, maybe even 3% plus inflation rate. That's just simply not the case. So this market, where we are with valuations, and we're as extended as they are, there's so much more room for downside than there is for upside.